Energy names mostly lower today, and it doesn't matter if it's old energy or new. Exxon, Chevron, and Phase all in the red following results. Starting here with Exxon and Chevron, we're going to kick it over to Pippa Stevens.
That's right, Morgan. Starting here with Exxon and Chevron, they are under pressure today after disappointing results but from Wall Street. So Chevron is the bigger laggard of the two, as weaker than expected international upstream profitability from its, once again, the international division more than offset a strong quarter for its downstream division. Now, free cash flow, therefore, was short of expectations. Exxon's EPS miss was smaller, driven by weakness in its refining and chemicals processing units. Still, the company raised its dividend to 95 cents per share. Now, for both companies, profits overall were higher quarter over quarter, thanks to rising oil and gas prices, although they were significantly below last year's high watermark. Now, turning to Phase, that stock is sinking after the company significantly cut its Q4 revenue guidance. The solar equipment manufacturer is facing issues on both the supply and demand side, especially in Europe. CEO Badri Kothandaraman telling me growth expectations in Europe are, quote, coming back to reality, meaning incremental versus the demand surge they saw immediately following Russia's invasion. And for the U.S., he said higher rates are the culprit and they need to come down to stoke new demand. Those shares down 70% this year, guys.
Pippa, we had an analyst on last hour who described the Chevron and Exxon quarters as messy. What does that mean?
Well, I think you saw divisions between how their different operations are performing. And so we saw, Exxon upstream was fine. Chevron's upstream not as great, thanks to some issues over in Kazakhstan with their TCO project. And then for downstream, Exxon's was a little bit better and Chevron's was a little bit messy. And so I think that for a long time, consistently higher oil and gas prices were just supporting profits across the board. It was lifting all ships. And now that that's no longer the case, we're starting to see a breakdown in terms of how efficient are your operations, how are you managing costs, and how are you getting those barrels to customers. Another thing with Chevron, was some of their shipping costs and when they actually realize the profits from their shipping operations. And so I think that's what it was. It wasn't as clear numbers on the headline. You had to look below the numbers to get more clarity on the quarters.
Yeah, Chevron also had all the LNG labor issues in Australia as well to contend with. I am curious, though, because we are seeing it in oil and gas. We're seeing this M&A activity. I mean, given how hard hit some of these new energy stocks, these solar stocks are, do you expect we're going to see consolidation there, too?
So one really interesting division between the U.S. oil and gas companies and the European players is the European players have been much more active in things like wind and solar, while the Exxons and the Chevrons of the world have said, we're never going to be a leader in those areas, so why would we pursue those avenues? So Exxon and Chevron's low-carbon solutions have focused on things like carbon capture and hydrogen, versus a Total, a Shell, a BP looking at solar and wind. However, to your point about U.S. consolidation, I do think that when stocks come down so much, it always begs the question of, will we see some mergers? I think you have to differentiate between some of the more commoditized portions of the market. Those are the hardware manufacturers like Phase and SolarEdge, and then the resi names. And also, this market is still very fragmented across the U.S. Even the largest players only have a very small share of the total market. So there is opportunity for consolidation.
All right, you came loaded for a very in-depth conversation here. Appreciate that. Pippa Stevens.